Today's guest is Jesse Walden, founder of Variant, an early-stage venture firm investing in crypto networks and platforms, building the ownership economy. Prior to founding Variant, Jesse worked as an investor and on a crypto education program at Andreessen Horowitz, and prior to that, he co-founded an early blockchain startup called Mediachain Labs, which was acquired by Spotify. Jesse, welcome to the show. Thanks for being here.
Thanks for having me, guys.
All right, Jesse, let's start with your background. I mean, you've got a super interesting path. What got you into tech? What got you into blockchain? And eventually what got you to start your own fund?
Right, so it's a pretty zigzag path if you look at it from a high level, but there is actually a straight line through it, which I'll try to explain. So I guess it goes back to sort of my formative years as an early teenager when I was pretty involved with piracy, much more than your average teenager was. So like most teenagers, and this was the early 2000s, most teenagers were downloading lots of movies and music online. And I was too, but I was also part of a much smaller community of people who were actually uploading the files that everyone else was downloading. And this was sort of at a time when, there was no YouTube, there was no Netflix. Cable internet, broadband internet was like just starting to get rolled out everywhere.
And I'm hoping the statute of limitations has already expired on this.
Yeah, well, I hope so too. But the intentions were innocent. It was really all about just having access to all the world's media at your fingertips. These files were available at that time on these FTP servers called top sites, where your IP address had to be whitelisted, and in order to get whitelisted, you had to play some sort of functional role in the community that was distributing all this stuff. And so what was interesting about this was a sort of like a very tight-knit, vertically integrated community where everyone was just there for the access. But it was sort of exclusive, and again, you had to play some role. Then there was a series of like innovations that basically broke the dam open and allowed everyone to get involved with piracy in a bigger way. So 2003, I think BitTorrent was invented, and piracy shifted from FTP servers to anyone with a BitTorrent client, and then eventually you had the rise of the cloud, and you had file lockers and mega upload and rapid share, where anyone could just host a file through their browser, download it there as well. And that's what really made piracy, I think, sort of a very mainstream phenomenon. At that time, you had great music blogs, great film blogs, because anyone could distribute media. And the reason I mention all this is, that's how I got extremely involved as a music junkie. Basically, I just became a huge music fan. And that led me down a path where I got sort of involved with the music scene starting in university. I went to school in Montreal, and there happened to be an amazing music scene at that time. I started throwing parties that led to throwing concerts. And eventually I decided I want to work with these artists in a deeper way. And I got into artist management. And I started an artist management company. I worked with sort of big independent artists, Solange Knowles, Blood Orange. These are sort of artists you read about on Pitchfork. But the goal of the management company was to use new internet platforms to help these artists reach their fans directly and monetize their work independent of the major label system, so that they could capture more of the value. And so the whole strategy, the management firm, was sort of informed by my experience, first in piracy, then later with new social media platforms that sort of came on the back of that. And so this was a very technology forward artist management firm. And I think it was 2013 or so when I read about the Bitcoin white paper, and I downloaded, I read the whole thing. And to me, what stuck out was the fact that Bitcoin was a peer-to-peer protocol that in many ways was sort of similar to the peer-to-peer protocols I'd used for piracies, but in particular BitTorrent, right? There was a lot of commonality in the technical stack. But the thing that really struck me was the fact that BitTorrent had something that none of the piracy protocols did, and that was it had an identity system built into the protocol. And that is public-private key cryptography. It's what allows your Bitcoin to be attributed to you as its rightful owner. And I thought, that's kind of what was missing from BitTorrent, from FTP. There was no identity as part of those protocols. And so while everyone was downloading and uploading stuff, nobody had the means to, say, hey, here I am, I'm the creator of this thing, or, I'm a fan of your work, and communicate with one another. And of course, that's the gap that social media platforms solved, right? That's what YouTube, Facebook, SoundCloud, et cetera, they solved that problem. So when I saw BitTorrent, or Bitcoin rather, I was like, wow, this is pretty cool, because it's a peer-to-peer protocol. Nobody controls it. It's user-owned and operated. Yet all the participants are represented in the system and have a means to attribute the value that they own, their Bitcoin, to themselves. So that was the spark for Mediachain Labs, the company I started in 2014. And we had the goal of sort of doing what Bitcoin did for a financial asset, for a different type of digital asset, in particular, a digital media asset. We wanted to allow creators to be discoverable through their work and attributed for their work, sort of independent of the platform where you consume it, just like a Bitcoin is yours, irrespective of the platform you use to engage with it, whether it's Coinbase or Binance. And so we set out to build this low-level protocol that would enable creators to ideally capture more of the value that they generate on platforms that distribute their work. So I think that's the straight line through my zigzagging career. It's always been a fascination with how media propagates on the internet, and then how creators can capture more of the value that they generate. And today, that idea extends not only to creators of media, but creators of all kinds of value online, since we're all really creators when it comes to internet products and services that we use every day. So that's what got me down the rabbit hole. It's what was the spark for Mediachain Labs. And that company was, as you mentioned, it was acquired by Spotify, led blockchain R&D there. And then I sort of took a switch and put on the investor hat to take a sort of wider view of all the activity that's been happening in the space. And I did that by joining Andreessen Horowitz, and then more recently by spinning out my own fund, Variant, to focus on really early stage investing in the category.
Nice. That's it's a fascinating path, especially. I mean, I think a lot of us have that in common, where we started on the BitTorrent world, and realized like all the power of this peer-to-peer stuff, and I exactly have the same background. So let's switch gears to Variant. Tell us about the Variant fund, what its thesis is, where you invest, and then like the user-owned economy, right, more broadly.
Yeah, absolutely. So yeah, the Variant fund thesis is also informed by the history with piracy. So I think if you look at crypto networks today, I think there's a parallel to draw in how they might reach billions of end users, just by looking at the sort of recent history of protocol innovations past, right? So BitTorrent is an example that I like to jump to, where BitTorrent was a protocol breakthrough, in that, again, at that time, like, there was no streaming, there was no Netflix, no YouTube when BitTorrent was invented in 2003. And here comes this protocol innovation, for peer-to-peer transfer of bits, that allows everyday internet users to get the experience of instant playback on movies and music. And that was sort of a new model, new user behavior that just wasn't possible before the protocol breakthrough enabled users to express demand for it. And sure enough, there was a lot of demand for that mode of accessing media, because at its peak, BitTorrent ate up a half of all internet bandwidth. And one person who saw this, I think, up close and personal, was Daniel Ek, the founder of Spotify, who at the time was the CEO of MuTorrent, which was one of the biggest clients for downloading stuff. So he understood very well, yeah, people want access to media in this, on-demand format. And that was the, spark for starting Spotify, right? So his insight was, take this sort of new model exposed by the protocol breakthrough of BitTorrent and productize it, make it clean, accessible, and you'll have a recipe for a very successful business. And I think he was right about that. Now, if you fast forward to today, I think there's a parallel in what's going on in crypto, in that crypto tokens are a protocol level sort of breakthrough like BitTorrent was. We can now move value in the way that BitTorrent allowed us to move information, peer-to-peer instantly to anyone, anywhere in the world. And the result, I think, has also been the exposure of sort of a new model or a new way of building internet products and services. And that sort of new model exposed by the protocol breakthrough of crypto is an opportunity now for founders who are sort of doing what Daniel Ek did, which is productizing it and making it accessible to a much wider audience. And when I say, you know, there's a new model, let me be clear about what I mean. And it's that because we can distribute value like packets, there's now the potential to build internet products and services that are entirely owned and operated by their users. And that's what's core to the success of Bitcoin and Ethereum today, which are the first, you know, crypto networks where there is no company. There's just a network of machines all over the world that are run by, you know, independent people who actually own and earn an ownership stake in the network in exchange for their contributions. And that same idea is now starting to get productized and be realized in other verticals outside of the you know, very technical communities that sort of comprise the early Bitcoin and Ethereum networks. So you're starting to see it in finance, you're starting to see it in consumer marketplaces, and, you know, and like the marketplace you're building in Brain Trust. So that's the Variant Fund thesis, is that, you know, crypto networks have exposed an economic foundation for the next generation of internet products and services, which are going to be owned and operated by users. And, you know, this may sound like a nice social endeavor, which I think it is, but in fact, it's really just the most market-driven way to build networks. It's the, you know, when you give users ownership over the products and services they use, it's a very strong incentive for them to adopt these, you know, new platforms and contribute to them. So the view is that we can build networks that are bigger and grow faster by virtue of deploying this new model.
And so Jesse, I'm curious, like, you know, it's clear, like, what the benefit is to the user, right? Like, you get to be a part of the networks that you operate on. I want to kind of slim it down for, like, why would investors want to invest in user-owned networks, right? Like, maybe you can apply that lens. You know, there's tons of venture guys that they're kind of like trying to discover this new space, but, like, as an investor, why would you want to, you know, partake in one of these user-owned networks?
Yeah, so the view is that that these networks can grow larger than traditional, you know, shareholder-owned companies can, and the reason for that is that they user-owned networks can remain aligned with users over time, even as they scale up and grow, which I think is not the case for many shareholder-owned platforms, and that's because, you know, traditional companies, internet companies in particular, they follow a very predictable path of growth, which is sort of S-shaped, right? You start off slow, then you hit some exponential growth, and you sort of hockey stick up and to the right. But at some point you plateau. And once you plateau, that's when shareholders start to say, okay, now it's time to get a return on the investment that fueled that hockey stick growth, and we're going to start extracting value from our users. So, like, with Facebook, that means more ads on your eyeballs, right? And it actually lowers the quality of the product. People start leaving. You start to get negative network effects at that point. And it's sort of like, you know, it's almost like a war of attrition. Will the investors extract too much to the point that everyone leaves, or, you know, or to the point where the product just becomes less useful? Now, user-owned networks don't follow this same trajectory, and that's because there's, you know, at the point that you hit the top of the S curve, you have sort of a group of people governing the platform who don't want to extract and squeeze the other users, their peers, because that would, you know, that would hurt their own interests, right? And so the network can remain better aligned with users over time, and as a result, serve as a more solid foundation for those users to continue to build on top of and extend. And so it may be the case that you actually don't hit the same top of the S curve because a user-owned network that is sort of cooperatively aligned with the people that interact with it every day is sort of a better foundation for trust to continue building and building on, you know, more and more services on top. And just one other way to sort of, I guess, come at this in more concretely is, if you look at traditional, you know, networks like Facebook, Twitter, Spotify, and so on, one of the ways this sort of S-curve extraction manifests is very evident in the developer ecosystem, right? So many of these companies had very rich developer APIs with a rich ecosystem of third-party apps. And as they hit the top of their S-curve, they shut off those APIs and killed the sort of innovation that was happening from third-party developers in order to, you know, again, squeeze and extract as much value as they could in-house. So don't let the value go to third parties. With crypto networks like Bitcoin and Ethereum, you have rich developer ecosystems of developers building lots of third-party apps on top, but nobody can shut it off. And in fact, nobody would want to shut it off because the developers building on top actually own the underlying platform. So they benefit from its, you know, sort of composable reuse. So that's how you know, you can draw the conclusion that these networks can grow larger through better economic and sort of governance alignment with their users. And that means that if you invest early in these networks, there's still potential for venture scale returns on your early investment as, you know, the value, you know, appreciates with more demand and more use.
Yeah, I mean, it's funny. We met I think a couple of years back, and both us and you had the sort of the seeds of this were starting to germinate, and you know, we've sort of independently arrived at the same conclusion that, you know, user-owned and operated networks will grow faster and become more valuable than investor-owned. Right? It's a
Right.
simple premise, and it's not just better for the participants. Like it's not just morally better. It's actually better for business, right? It's better for everybody.
Yeah, right. Exactly. It's another facet of this is that if your users have a direct economic stake in the success of a platform, they're highly incentivized to, one, adopt it, two, contribute in deeper ways than they would otherwise. And if you zoom out and look at the big picture of how sort of software has evolved over the last 20 years, this isn't really that far-fetched, even though it might sound like it at first hearing it, you know. And the reason it's not that far-fetched is, you know, the biggest, I think, surprise in software in the last 20 years is the success of open source. Right? Like today it powers, you know, trillions of dollars of value that's been built on top of it, you know, from all the devices in our pockets to many of the major internet platforms that we use. Each of them depend on open source components. And those are components that are crowdsourced from people all over the world. And so that's an example of you know, people just sort of contributing immense value. And that's doesn't come from a company. It comes from, you know, ultimately the users, the developers who want to use this stuff in their applications. And in turn, the applications that have been built with open source components, like many of the Web 2 platforms today, they too crowdsource much of their value from their users, whether that's content or products in a marketplace. You know, the value of many of these platforms is the users. Now that we have this means of distributing value at internet scale in very granular transmissions, and that is, you know, the technology breakthrough of tokens, it's no wonder that users are going to take the next step and start to contribute to platforms in deeper ways. It's not just going to be open source code or, you know, content or products. It's going to be actual operations of the platform itself. And that's what you see in Bitcoin. That's what you see in Ethereum. And it's what you're going to start to see across many more consumer facing marketplaces and networks. And if this does play out, and it already is, it means that the cost to building these networks drops dramatically, because no longer are you hiring people into a company. Instead, you're outsourcing the work, or you're crowdsourcing the work from users who earn a direct stake in the platform value for their contribution. And that's just a much more efficient model, both economically, you know, in terms of financial capital and production capital, than sort of the corporate model, where you have to raise tons of value, and you can only sort of tap into the talent pool of people that are willing to, you know, or are allowed to work at your company and earn equity investments. So that's another reason that I think these networks can be more valuable due to their sort of efficiency gains.
Yeah, yeah. I want to just double click into that for a second, because I think it's not a well understood part about why you would want to organize a network this way. Typically, and Adam and I've been around this, and as of you, like typically you go and you raise $1 billion of venture money to build a two-sided marketplace or two-sided network, and you invest that in essentially either subsidizing one side or trying to like incentivize people to come and play in the sandbox, right? I want to use maybe even a more concrete example, and like let's talk a little bit about how a token can actually be used to help a marketplace grow faster than traditional kind of investor-owned marketplaces, and also how it can solve some of the problems in the early days of a marketplace when you're trying to get enough supply, enough demand to kind of show up and play in the sandbox.
Right. Well, so I know you guys had another episode of the podcast with Robert Leshner from Compound, right? I like to use that that marketplace or his product as an example. I'm not sure if that would be redundant for your listeners, but that, I think that's a really good example of how to sort of bring one of these projects to market and what the advantages of doing so are. But let me know, is that going to be redundant?
No. Go. Yeah, do definitely a high level on comp, and then as well, if you can think of other applications in two-sided marketplaces that aren't DeFi, right?
Sure. Okay. Yeah. Sure.
We're also happy to talk about how brain trusted it is. If you want to like dig into that and use that as an example as well.
Yeah. Let's do that. I think it'd be great to talk about it. So, okay. So I'll start by saying that I think, usually with, the classic problem with any new network or marketplace is a chicken and egg problem. Like, how do you bootstrap supply or demand in order to get network effects going, right? And as you mentioned, like typically one way you do this is by raising venture capital and subsidizing one side or the other. But the issue with venture capital is that it's, or not the issue, but one fact of venture capital is that it's dilutive, right? It's dilutive to the founders. In crypto networks, there's an opportunity to sort of use that dilution in a very productive way. That's kind of similar to the venture capital model, but slightly different. So in venture, you raise a fundraising round and subsequent rounds thereafter, and the early founders, the early investors all get diluted by those subsequent rounds of financing. And the idea is you're going to use that financing to fuel growth and grow the pie for everyone. In crypto networks, you do something kind of similar, but there's an important nuance, and that is you create what's called like a token table. It's kind of like a cap table. And what you do is, the founding team will maybe build a product, build a network that's useful, and put it out there, make it accessible to anyone to run. And then they'll take some tokens and they'll distribute them to the users of the platform or service as an incentive to drive their adoption and fuel growth. And that distribution of tokens could be seen as being dilutive to the founders and their early investors. But when you think about it, it's not really any different from the dilution that that's taken on in traditional VC, and that distribution of tokens to users is what's driving the growth. And so it is hopefully a tide to raise all boats. And so I know with what you guys are building with Brain Trust, you're doing something similar, right? Which is at some point right now you have a product in the market, and it's useful. People are using it. There's demand from Fortune 500 companies on one side. On the other side, you have a lot of tech talent that are being hired by these guys. And in the middle, you have a marketplace that's sort of facilitating these transactions. What's different about your marketplaces versus traditional talent marketplaces is that the users, both suppliers and demand on both sides, are able to earn some of the platform value in the middle, and not only the value, but the governance over the platform itself as well, right? So that they can ensure that the values of the platform remain aligned with them, and that's an incentive for both to sort of jump in and participate. And so, I mean, I'll leave it to you guys to fill in the blanks there, because that's a very high level summary. But suffice to say that you guys are driving growth through distribution of the platform value to the users directly, right? And that's how you've gotten started and how you continue to fuel growth of the platform.
For sure. You know, it's funny, you mentioned earlier, like raising tons of venture to bootstrap and get the thing off the ground. You know, we have 8 employees, including us. Half of us don't take a salary. And we've been able to build this giant marketplace that's doing millions and millions of dollars a year in GSV, and growing, like now it's like 40% month over month. And like, we have like our core team barely exists, right? I mean, like everything done from engineering to UI design to marketing, copy, social media is all being done by the community in exchange for tokens. And what's interesting is, like, almost, it's 80, we polled them, 87% of the people that like have a brain trust token, or it's not a live token yet, so it's a credit that will convert to a token next year.
Right.
Have never touched it. They've never custodied a token before. And many of them had never even heard the term token in this context. So we're kind of like, how could this be an incentive mechanism if it doesn't even exist, and most of these people have never heard of it? And it turns out, like, when you just explain it to them in terms of control, like, that you get to vote on the rules, that, like, they love that, right? Because what they're afraid of is what you just described a few minutes ago. What Facebook and Twitter and all these guys did was, as the thing starts to get useful, you know, the fees go up, and it becomes, you know, very extractionary. And so if you're a freelancer making, you know, money, basically making your living on a network, like, you care a lot about what the fees are. And so these folks are like, it's become this, like, it was surprising to us how quickly this became like a clear incentive mechanism for them. So it's exactly your example.
And I'd love to dig into something here, Jesse, which is that, you know, there's maybe 20 or 30 of us that kind of see the world in this way right now, right? It's still like, it's really enjoyed the conversations with you. But this space hasn't matured enough yet, because nobody can point to the example of this thing growing faster and becoming more valuable than a traditional network, right?
With the exception of maybe Bitcoin, right? Like, Bitcoin may be the one exception to the rule where it really did bootstrap the network in the early days, but the fact that the miners earned Bitcoin for securing the network, that it solved the chicken and egg problem and got the network secured. And then now Bitcoin is, you know, multi-billion-dollar network at scale, largest computing network in the world. And so it's the first example, but you're right. Like, we haven't yet seen an example that's, you know, not on the fringe and more consumer facing. And part of that, I think it has to do with the fact that, as you touched on, most end users, consumers, don't understand the value of a token. It needs to be productized. We still need that Spotify moment where, you know, great founders like yourselves come along and do what Daniel Ek did back when he started his company, right? Which is take the insights of the new model exposed by the protocol breakthrough and turn it into a product that's way more accessible to everyone. And that I think is going to be the 0 to 1 moment where, you know, way more than 30 people realize there's a huge opportunity. There is a new model for building internet products and services in this way.
And I actually think there's kind of like, you need those examples to pull out kind of 3 core kind of constituents that like make this the new way. Like, one is, you need to show why this is important to investors, right? Like, you need to show that these things can grow very, very fast, become valuable.
And unlock new markets. The second thing is, you need to show that to the next generation of entrepreneurs. People need to get excited about building internet companies in this way. And the third, to your point, is, you know, users need to see the value of governance and ownership. And that's kind of like what creates an ecosystem for the next generation of you know, internet platforms, internet networks that are user owned. And we're just not quite there yet. So I'd love to hear, like, you know, how do you think the next kind of couple years of the ownership economy play out?
Yeah, so it's a great question, and I totally agree with you that it's, you know, you need winning examples and case studies to point to in order to get the next generation fired up about it and sort of following the playbook. And the good news is that I think, emanating from the crypto space today, there is increasingly more and more of a playbook. So it's, it started with Bitcoin, then Ethereum, first two networks to really achieve success in an entirely user-owned and operated way. Now, on top of Ethereum, which is a developer platform, you are starting to see lots and lots of developers in the category of DeFi or decentralized finance start to employ a similar model for marketplaces that are financial in nature. Like, Compound is a marketplace for lending and borrowing. There's Uniswap, which is an exchange, right? And so think Lending Club, think Coinbase, right? Same marketplace. What's different is not the business model. The business model for each is the same. There's a fee taken on transactions in the marketplace. What's different is what's done with the fee, which is it's just going to be distributed directly to the end users who govern the platform in exchange for their work. And so you're starting to see that happen in DeFi, and many of these platforms, these DeFi platforms have been wildly successful at driving liquidity to their marketplaces by using this model. So there's some validation there that, yeah, it's working here too. And now you're starting to see it sort of, I would say, cross the chasm in other verticals that are more consumer facing. Brain Trust is one. Reddit is running this great experiment right now where they're starting to distribute tokens to those that contribute to subreddits on the platform, like moderators and people who post content. They're able to earn community currencies, the value of which derives from product features that Reddit's built, like private or premium subreddits, gifts, badges that you can purchase with those community currencies. And the idea is that as the demand to participate in these communities grows as a result of the great work that the community is contributing, the value of those currencies should go up in value, and all the early contributors benefit from that. And Reddit Inc. also can benefit from that too. But most importantly, value aside, will be that these community currencies will confer some governance value over the subreddits to ensure that that the subs can sort of continue to exist and operate independent of Reddit Inc. And I think that's pretty key and exciting. So you're starting to see it in consumer social, but too early to call that a breakout success. Hey, did I lose you guys?
Hey, Jesse, I'm still here. Let's see if we can get Adam and Gabe back, and maybe they just lost Wi-Fi.
Okay.
Rolling blackouts in California.
That's right. Yeah. And good thing you're recording it, not them.
Seriously. They said they're going to be on in 1 minute.
Okay.
It's funny, right before the call, I said, did you guys have any blackouts this weekend? And we were like joking about it. And we were like, watch, it'll happen during this call.
Yep, there you go.
Here you go.
Hey, sorry about that.
No problem.
We
Internet or blackouts?
Yeah, well, we have like a small hurricane blowing through here in Marin.
Oh, really?
And so we just blacked out, but it just came back. So
Okay.
we can keep rolling here. Yeah, we're recording. Okay, thanks. Cool. All right. Sorry about that, dude. We're
You did a costume change?
Yeah. Well, my hair was getting a little wild, so I figured I'd spare you guys.
Nobody wants to hear our complaints, right?
No, no complaints over here. I mean, I feel for you guys with the hurricane, fires, blackouts. I mean, sounds bad.
It's not easy to stay in California. I'll say that.
Yeah, that's right.
Oh, I was talking about our complaints about unruly long hair.
Oh yeah, that too.
No one wants to hear about that, Jesse.
Oh. Got it. Sorry, I didn't make the connection.
All right, so let's keep jamming on the user-owned economy. So this, I think we've done a good job here, the three of us, of kind of making the case here that these user-owned networks will grow faster, be more valuable than investor-owned. I feel like, so Brain Trust plays in the talent economy. It's kind of low-hanging fruit. It's kind of a no-brainer. The DeFi thing, I think, is Robert's really done a great job there, and others, of course. I think gig economy, like kind of the last mile food delivery, people delivery, I think that's low-hanging fruit too, because you're seeing the extraction part of the S-curve really hurt the participants. What are your thoughts on gig economy succumbing to this? Do incumbents tokenize themselves? Will Uber issue a token, or is this fertile land for disruptive new startups?
Yeah, no, I think certainly the latter. So what's interesting is both Uber and Airbnb have petitioned the SEC to be allowed to make their supply side hosts or drivers, respectively, stock option holders, because they understand that giving ownership as an incentive to those suppliers is a much stronger way to build defensible network effects and lower the cost of acquiring those suppliers, retaining those suppliers. However, I think it is a challenge for a big company like Uber or Airbnb to sort of pivot their model, get regulatory approval, and really prioritize this from, as a first principle of the platform, because that's not where they started. So I do think there is an opportunity for startups to come in with this model as sort of a core tenant or keystone of their product experience, and attract users and build marketplaces because of it. So and to your question about is the gig economy ripe for this? I think absolutely. And you're starting to see sort of manifestations of the same idea in this space. So there's a startup called Dumpling, which is food delivery marketplace. And what's interesting about Dumpling is that they empower the suppliers in their network, people who do the shopping and delivery, to actually own their own business independent of the platform. So rather than than commoditizing the supply side, they're actually empowering the individuals who operate local delivery services to build relationships directly with their customers. So it's sort of like the Shopify model versus the Amazon model, right? Amazon wants to commoditize all their suppliers and make it all just appear as Amazon Prime, right? You don't know where it's coming from. Whereas Shopify is really embracing the individuality of each of the suppliers or retailers on their platform and helping them to connect with their customers direct. So I think Dumpling is a step in the right direction. And the next step is to take some of the platform value itself and give that to the suppliers as well as an incentive for them to contribute in deeper ways and ensure that the platform stays aligned with them over time.
Interesting. So I want to just talk a little bit about from the investor lens real quick, and then we'll kind of transition into what we call the lightning round. Okay. But let's talk a little bit about from the investor side, right? Right now, the state of the world seems to be that there's kind of regular traditional venture funds that raise large institutional capital to invest in equity in Delaware C corporations, right? Mm-hmm. And then you have kind of an emerging class of fund managers and investors in crypto, but typically much smaller funds. But there's kind of a gap in the middle right? Like both a gap in knowledge and expertise and fund size. So I'd love to explore kind of like, how do you think about that gap between like the entrenched institutional funds and like, you know, kind of the upstarts of where you're at right now? And how do you think this evolves in the coming years?
Yeah, no, it's great. It's a great question. So yeah, it's interesting. I think for the most part, traditional VCs have not been super active in the crypto space. The term the ownership economy is something, you know, I published a blog post, I guess about a month ago now. You guys have been talking about the user-owned economy for some time, right? But it's, as you pointed out earlier, it's not well understood. So there's only a few people active there right now. And then separately, there's this whole ecosystem of crypto funds, some of which are actually, you know, fairly large. Like A16Z, my former employer, has a $500 million crypto fund. Paradigm is up there as well. And so there are a lot of funds investing in user-owned networks, but currently those are, for the most part, limited to what I would call crypto-native networks, right? Which are networks like Bitcoin, networks like Ethereum. And here at Variant, I'm investing in crypto-native networks because they're, you know, like I said earlier, they were sort of the first to realize the success of this new model. But they're, you know, I'm also trying to invest in founders building the ownership economy, which are those founders that are productizing the insights of crypto networks and making them more accessible. And there, I think there's not really many VCs playing at all, right? Because there's sort of a disconnect on both sides of the spectrum. The traditional VCs don't really see the opportunity in crypto networks. They don't see the new model. And the crypto native investors are sort of looking, you know, maybe a bit myopically at the technology stack, the developer infrastructure, and what developers are doing today, which is totally a viable strategy. And I'm doing that as well, but I'm also thinking a little bit further out about how this technology stack goes on to touch billions of end users. And I think that happens by virtue of productizing the technology breakthrough. So if I had to speculate on where we're at, you know, 2-5 years out from now, you know, what I'd like to say is that we'll have a breakthrough ownership economy platform that is consumer facing within that time horizon. And that will be the 0 to 1 moment where both the traditional VCs and the crypto VCs realize, hey, this model is bigger than we thought it is. And it's actually this new foundation for building internet products and services. And that means, you know, there's more competition for Variant, which is tough, but it's also a good thing because it means there's many more opportunities. And hopefully by that point, Variant will have become synonymous with this model or with the ownership economy. And that'll be an opportunity to partner with way more founders.
And so there's also going to be like that first success story is going to bring in a lot of entrepreneurs, right?
Right.
To go in. So there's actually going to be more supply of really talented entrepreneurs that see this as a new way to build platforms and networks. So I think it's, yes, there'll be more capital, but the ecosystem will just evolve. So there'll be more entrepreneurs and actually more businesses being built in these categories.
Exactly. And in fact, it's worth noting that you can quantitatively say this is already happening right now. A16Z did this put out this great study actually that shows in the crypto world, price is actually a leading indicator for talent flowing into the space. So, you know, yes, if you look at the price of crypto, Bitcoin, Ethereum over the last 10 years or whatever, there's many boom and bust cycles. And you could say, oh, it's all a wash when the money flows out, but it's actually not the case. And what the data shows is that when the price goes up, it actually does attract the attention of a lot of developers who rush in and start, you know, tinkering with the technology and building stuff. And many of those that rush in actually stick around even when the price washes out in the bust cycle. And so there is this sort of linear march to more and more talent getting into the space and getting started. And that talent, you know, as we touched on in the crypto native world, are currently building DeFi platforms that are user owned and operated. And so, to your point, once there's one more breakout success, there'll be another cycle. Many more entrepreneurs will rush in, and that's how you know, this space will reach mainstream adoption.
It all goes back to incentives.
Yeah, totally.
Yeah.
Yep. I want to stress the point again that user-owned and operated networks are not just a social endeavor. They are just the most market-driven way to build networks and build network effects. And again, it's just direct economic incentives are a hell of a drug to get people started using a platform, contributing to it in deeper ways.
Yeah. Well, this is one of those things, and one of the reasons that we love talking to you about this is definitely a contrarian perspective. But I think all of us we're going to look back on this and say like, well, we were contrarian and we were right.
Yeah.
And that's kind of where the interesting magic happens, right?
Absolutely. Yeah.
Cool. So yeah, let's transition to this, what we call kind of a lightning round. So it's just like stream of consciousness, kind of quick wrapped up answers. We'll do this for just a couple minutes. First question is, Jesse, what have you learned about yourself during shelter in place?
Interesting. I mean, I've learned that there's a lot. I guess I've sheltered in place in New York City during the height of the pandemic, and then more recently I've been up in Canada, which is where my wife is from. While I was born and bred in the city, I've learned that I can actually be pretty down with country living. So that's been great, and it's been a realization, I think, coming back to our conversation, that it's really possible to work from anywhere. And if the ownership economy is going to be realized, I think that, there needs to be more acceptance of that, because talent is all over the world. I guess I found that, you can do it anywhere. So that bodes well for the thesis and sort of, where I think the world is heading.
Well, we couldn't agree more with that. We've been the distributed engineering team people before that was a cool thing to be. Second question. Well, so tacking onto that, Silicon Valley, you think it's on its way up or on its way down?
Well, I think Silicon Valley is really a state of mind, more than a physical place, and I think I've always kind of believed that, because I've never really lived in Silicon Valley. I spent a ton of time out there, but I sort of refused to give up on my roots in New York. But I definitely consider myself part of the Silicon Valley state of mind. And so I think, with the way information propagates now, more and more people are joining the Silicon Valley in the sky. And that's, I think, only going to continue irrespective of what happens to the physical location.
Sure. So I think related to that, to kind of our views on future of work, what's an old way of working that you hope never comes back?
Yeah. I mean, I would love to, not ever see people wearing suits on the subway in New York, going to some like crammed office. It seems archaic. And that's not to say that, like, in-person meeting is without any merit or value. I mean, certainly there is a value to having face-to-face conversations with folks, but I think just the sort of like drab routine of suiting up and like crunching into an office, having tons of meetings that way is got to be a thing of the past for most industries.
Yeah, well, can't agree more there. Final question, inspired by Peter Thiel, and granted, this whole conversation may be the answer to this question, but what's something, Jesse, that you believe strongly that is a widely unpopular view today?
Yeah, I think really the thesis of my fund is that for me, right? But I guess maybe just go a little bit deeper into it. I think the CEOs of the future, the leaders of these new networks that we're describing, are going to look and sort of feel qualitatively different from the CEOs and founders of sort of like the Web 2 era, in that they're not going to be just sort of like excellent operators and executors. They're going to be something more akin to like a politician, which maybe is too strong a word, or it comes with a negative connotation, but they have to be sort of stewards of an open community of contributors, which is very different than sort of taking a top-down command and control approach to building a company. And so, yeah, I think that means that the archetypal sort of founder that Silicon Valley has gotten excited about over the last 10, 15 years may be sort of the wrong persona type for this new space. And so it'll be interesting to see how that transitions, given, you know, the earlier comments on the future of work, the potential for these networks to be open to a global talent pool. Hopefully it means we see a much more diverse set of leaders emerging in the space.
No doubt. Yeah, we couldn't agree more. Well, listen, Jesse, this was an awesome conversation, as always is with you. Thank you so much for joining us. Where can people learn more about you, reach you?
Yeah, so the fund website is variant.fund, and I have a lot of personal writing on my blog, which is just jessewalden.com.
Yeah, we've been a fan. Your progressive decentralization piece is great. Your recent launch post was awesome. Big fan of your work. All right. Well, hey, thanks again for being here.
Thanks,
Thanks so
Jesse.
much for having me. Great to talk to you guys.
Great to have you.